Good day, Junior Tickies. I'm Mrs. Brimacombe. We are going to look now at Chapter 10, Budget. Now, before you start with this activity, it's important to understand the theory. So make sure that you go through your theory booklet. Know what is the difference between a cash budget and a projected income statement. Note that when we look at a cash budget, we're looking at receipts and payments only, which means that all non-cash items should be excluded from a cash budget. So when we're talking about non-cash items, we're talking about things like discount allowed, discount received, bad debts. That will never appear in a cash budget. But discount allowed, discount received, bad debts are an income or expenses, which means that will go to your projected income statement, because a projected income statement shows our income and expenses. It's basically your income statement, but on a monthly basis. So looking at activity 1, our focus in this activity will be on the debtors collection schedule. You are provided with the information related to G&A stationers. So if we look at question 1.1, why is it necessary to prepare a debtors collection schedule? Goods are sold for cash and on credit. If you look at the example below, your sales, your total sales consist out of cash and credit sales. So when we're looking at debtors collection schedule, we're looking at what do we expect our debtors to pay us on a monthly basis. Yes, we do have our credit terms, which could be, for example, 30 days. And in a perfect world, all debtors adhere to those credit terms, but unfortunately it doesn't happen. So we are going to now work out, based on past trends, what do we expect our debtors to pay us so that we can budget accurately on a monthly basis. Your total sales will always appear in your projected income statement. Your cash sales will go to your cash budget, and the credit sales will be used to complete the debtors collection schedule. So if we now look at what is the information which was given to us, we're going to first look at this, and this is our workings before we start with the questions. They provided us with the actual and the budgeted sales, and debtors are allowed 30 days. They pay according to the following trend. So when we start, we are going to start with the total sales, which is given to us. They said credit sales amount to 65% of total sales, which means then 35% is cash and 65% is on credit. Now, how do we get that? Total sales equals 100%, 100 minus 65 equals 35. So if we're calculating our cash sales, we will take our total sales times 35%. Now I've got two options to calculate the credit sales. I can either take my total sales minus the cash, or we can say total sales times 65%. Looking at debtors are allowed 30 days. They pay according to the following trend. 30% settle their accounts in the month of sale and receive a 5% discount. So this means in the same month. 45% settles their accounts in the following month, which means if we sold goods on credit in October, we expect 45% to be collected in November of the outstanding debt. Then 18% settle accounts in the second month following the month of sale. So this means if we sold goods on credit in October, we expect 18% of that to be collected in December. Now, provision is made for bad debts in the third month following the month of sale. This means 30 plus 45 plus 18. If I add that together and I minus that from 100, because my total debt equals 100%, it means that 7% will be written off as bad debts. And this is what we expect to happen. So from the October credit sales, we expect 7% to be written off in January. Remember, this is now my workings. Because from here, if I'm asked to complete the debtors collection schedule, I've worked out now for each month, what do we expect, what percentage to be collected. If I'm asked to calculate the bad debts, I know exactly from the October credit sales, 7% will be written off as bad debts in January. This is an example. So question 1.2 asks us to complete the debtors collection schedule for the period January until March. Now, we start with the credit sales. We've calculated our credit sales, 65% of the total sales is on credit. So starting now with the month in January, I'm not going to use October. Why? Because 7% is written off as bad debts in January. Bad debts is a non-cash item. It goes into the projected income statement. It's not money that we are going to collect, so it will not be included in the debtors collection schedule. This is why we start now with November. From the November credit sales, we expect 18% to be collected in January. The 7%, I'm not going to do anything with that in the debtors collection schedule. Why? It's a non-cash item. It goes into the projected income statement. From the December credit sales, we expect 45% to be collected in January, 18% to be collected in February. Again, we do nothing with the 7%. From the January credit sales, we expect 30% to be collected in the same month. But now you need to be very careful. Of that 30% that we are going to collect, that we expect, we are going to allow them 5% discount, which means that we're actually going to collect less money. This means that you need to calculate first 30% of the total credit sales, and then we expect 95% of that to be collected. Why 95%? 5% discount will be allowed to those debtors. And discount allowed is an expense to the business that will appear in your projected income statement. If we look from the January credit sales, we expect 45% to be collected in February and 18% in March. Now we can go on to February, and the same applies as before. From the February credit sales in the same month, we expect 30% of the debtors to pay us. But because 5% discount is allowed, only 95% of that will be collected. In March, from the February credit sales, we expect 45% to be collected in March. And then if we look now at March, in the same month, 30% will be collected. But because 5% discount is allowed to those debtors, we're going to collect 95% of that outstanding debt. So now we've completed the debtors collection schedule. So the last step is to total each month. And this is what will appear in your cash budget. Now, the next question, 1.3, calculate the total cash sales from January, February, and March. So if you look at our workings that we've done, we've basically already calculated this now. If we look at January, February, March, that is our total sales. 65% of it is on credit, which means 35% of that will be cash. So to calculate the cash sales, just to go through it again, to calculate the cash sales, take the total sales times 35%. And that will be the cash sales for each month. Question 1.4. Calculate the following. The estimated bad debts to be written off for the period January to March 2022. So this is one of the reasons, again, why I do this workings before the time. It might seem like a waste of time, but when you look at the questions that is required of you to complete, use this in the beginning, complete it, and then it becomes much easier to complete the questions because now we've already done all the hard work by filling in what do we expect to collect when and what do we expect to write off when. So the question says, estimated bad debts to be written off for the period January to March. There's January until March. So what are we looking for? We're looking for the 7%. So in my calculation, it will be from the October credit sales. We expect 7% to be written off in January. From the November credit sales, 7% in February. From the December credit sales, 7% in March. So that will be my estimated bad debts to be written off. Question number B, the total estimated amount still owed by debtors at the end of March 2022. So we can look at our workings again now. And what do we look for now? What is still outstanding by debtors at the end of March? Starting with October, there's nothing. Because if I add all of that, it equals 100. November, there's nothing. December, nothing. But when we look at January, in January, the budget period, we expect to collect 93% of the total outstanding debt. February, 75%. March, only 30%. So to find out what will be the outstanding, take 100 minus the percentage that we expect to receive. So this is why our calculation will be in January, the total credit sales times 7%. February, the total credit sales times 25%. 100 minus 75 equals 25. And March, 100 minus 50 equals 70%. And that equals the total estimated amount still owed by debtors at the end of March. Question 1.5. Refer to the January sales. Calculate the percentage increase in sales. So if we look at what's been happening, what do we expect to happen? This is our actual figures. Now from December to January, we can see that there's an increase in our sales, but then we expect it to slowly decline. So now we need to calculate what is that percentage increase that we expect to happen from December to January. To calculate that, take 432,000 minus 360,000 divided by 360,000 times 100, and that equals 20%. Question B, why are the January sales predicted to increase and then slowly decline from February? Now, when we look at right in the beginning, the name of the business, what is it that we are selling? We are selling stationery. Now, from January until February, there's a decline or decrease that we expect of 32,000, which is 7.4%. And then from February to March, 32,000, which is equal to 8%. Now, the business is selling stationery. So we expect January is the beginning of the year before school starts, and they anticipate that the demand for stationery will then increase, because everybody needs to buy stationery for back to school. Looking at the last question, comment on the debtors collection policy and give advice. So if we look at, debtors are allowed 30 days to pay. But according to a specific trend that we've picked up, 30% settle the account in the month of sale and 45% settle accounts in the following month. That means 75% is actually does adhere to our credit terms, which means 25% is after 30 days. 18% of that we expect to settle in the second month following the month of sale, and then in the third month we expect bad debts to be written off. So, to comment on this now, 75% of debtors does settle their accounts in 30 days, which means 15% of debtors settle their accounts after 60 days, and 10% of debtors is written off after 90 days. Just a correction, 18% of debtors settle their account after 60 days and 7% of debtors is written off after 90 days. So although most debtors are settling their accounts in 30 days, more can be done with that 18% and with that 7% which is written off after 90 days. So when we now give advice, what is our options? How can we improve this? Charge interest on overdue debtors account, send out statements before the end of the month, follow up with outstanding debtors, with outstanding amounts. So these are just some of the things that we can do to try to ensure that that 25%, which does not adhere to our credit terms, does pay us. Thank you very much. I want to leave you with this quote. Success consists of going from failure to failure without loss of enthusiasm. Next, we're going to look at activity 2. And in activity 2, the focus will be on the creditor's payment schedule. Have a wonderful day.